Welcome to Market Catalyst. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we are watching this hour. First up, Elon Musk warning of a tough road ahead for Tesla. We'll bring you the CEO's comments and what it means for the future of the stock. Plus, President Trump set to tour the Federal Reserve today as the White House increases pressure on Chairman Powell. Details to come. And Southwest warning of the impact of President Trump's tariffs in its latest earnings. We'll sit down with the company's CFO to break down the trust cost of the trade war. Let's get a check of the markets right now. Taking a look at the major averages here, we got a mixed picture happening once again. The NASDAQ and the S&P 500 higher. Remember, any higher close today will mean another record close for both of those averages. We're seeing some strength in Alphabet that's helping lift the NASDAQ, but the Dow is under pressure today. It's down by nearly 200 points, about 0.4%. And looking at the bond market as well there and where we're seeing yields, they're moving up, continuing to move up a little bit today. 4.42% is where we find the 10-year up about 3 basis points. On the company's earnings call Wednesday night, Tesla CEO Elon Musk warned of near-term weakness for the EV maker as the company focuses its efforts on upscaling autonomous ventures.
We're in this weird transition period where we will lose a lot of incentives in the U.S. On the other hand, autonomy is most advanced and most available from a regulatory standpoint in the U.S. I mean, does that mean we could have a few rough quarters? Yeah, we probably could have a few rough quarters. I'm not saying we will, but we could.
So what does that cautious tone mean for investors? Joining me now, longtime Tesla bull, Dan Ives, Wedbush Securities Managing Director and Global Head of Technology Research.
Great to be here.
Great to see you. So I got to ask you, when the CEO of the company is saying something like that, is Tesla dead money for the next year? Should investors even bother to get in here?
Look, in my opinion, this is a company entering a golden age. Because when I think about the future, it's about AI, autonomous, robotics. Now look, was this a quarter that you're going to frame on a wall? No. The next few quarters, could it be soft from a delivery perspective? Of course, and Musk hit that. But to me, it's about robotaxis. It's about physical AI.
Well, it might be about all of those things, but it's not all about those things now.
Sure.
It's not going to be about it next quarter or the quarter after that or the quarter. I mean, when is it going to be about all that stuff?
Go back to 22, when Jensen's wearing the black leather jacket and you're talking about AI in 2022, the haters, right, all in hibernation mode, they all come out and then think about AI 23 and the rest is history. My view is that we are in a fourth industrial revolution. And I think that's why for Tesla, it's not about deliveries. Now look, I think deliveries does rebound a bit in the second half, but it's all about 25, 30 robotaxi in cities over the next year. It's about what I view as robotics in terms of optimism. And look, I think the autonomous valuation alone is $1 trillion.
But here's the thing, Dan. You and I have been talking about Tesla for a while. And I got to be honest, you always say the same thing about Tesla, no matter what the company itself says.
Sure.
Elon could do anything. Well, you've pushed back.
Criticize.
You have criticized. Okay, to be fair, yes, but that more had to do with politics than
Sure.
But what's happening right now is not great for the company.
I agree that it's not great in terms of near-term fundamentals. Me and you have talked about it, and that's 100% true. And I could see some investors selling the stock. They feel like the next 1-2 quarters, nothing's going to be great. But to me, this is just the beginning of what's going to be an autonomous future, an AI future. And I think we will look back, me and you, 6 months, 12 months from now. You already might have been a robotaxi in New York City.
I have not.
No,
not
I'm
yet.
saying, but you might 6-12 months.
And
we will sit here.
I'd be more likely to be in a Waymo than a Tesla robotaxi, though, Dan.
So let's see. Because I believe Waymos are basically breadcrumbs relative to what the robotaxi opportunity is going to be for Tesla. But I'm just saying 6-12 months now, we look back in this period, this was a golden buying opportunity. I believe this is a $2 trillion market cap, but I get it. Look, they've hated Tesla the whole way through. Any issue like this transitional period going from EV to AI,
right.
I get the sell-off.
Okay, so let me ask you this. Even if we agree, we're preparing for an autonomous future, we're preparing for an AI future, even if we agree on that, why are you so convinced that it is Tesla that is going to be such a big winner? Because it is a very competitive field out there. any part of this you're talking about, whether you're talking about AI, whether you're talking about autonomous, whether you're talking about robots, any of it, there's a lot of other very smart people and companies working on all of it.
And it's a great point. I mean, look, my view is that first, when it comes to autonomous and it comes to like what they're building, I believe Tesla will essentially own the autonomous market. But it's also the view like Optimus, robotics, as that scales, humanoids, that's going to be a huge piece of the Tesla story. And then ultimately, I think by November, Tesla will take a big stake and it will get voted on in XAI. So my view is that this is going to be, when it comes to physical AI, one of the key players, along with NVIDIA, and of course, other big tech companies, Microsoft, Meta, and everyone else is going to play. But it's a fourth industrial revolution. And I think viewing Tesla just as a car company, it's saying Scheffler is just a golfer. It's saying, LeBron's just a basketball player. I view this much different in terms of where this all heads.
You mentioned November as being another catalyst. There's something else happening in November, and that's the midterm elections, right? And as you alluded to before, sort of one of the things that you have pushed back against is Musk's involvement in politics. He says he's starting a political party, right? So is that going to be another challenge, another distraction for him?
Yeah, but since that July 4th, whatever, over a barbecue when he put that out, he really hasn't talked about it. And look, and we push back at it because my view is that you need a wartime CEO, just like what you see with Zuckerberg and Meta. And that's essentially what we see Musk starting to do. I continue to think the biggest asset for Tesla is Musk. So you're starting to see a different Musk driving the AI future. But even Trump, let's say like last night, pushed back in terms of some of the comments, maybe from press secretary about Musk's AI ventures. That's something the government wants to shy away from. But now you see Trump backtracking on that, and I think really trying to embrace Elon in his latest tweet. So my view is that Musk is going to be a part of the AI future in the US, but you cannot, from a politic perspective, that is something I view as a lose-lose situation.
Do you think that Tesla has an absentee board?
I think Tesla has a board that's had minimal backbone. People can say it's a rubber stamp board, but I do think you're now getting to a point where the board's going to have to step it up. In terms of giving Musk 25% voting, right? So I think that's important in terms of the AI initiative, especially when it comes to XAI. But then also, we've said, guardrails are just some outlines in terms of like, look, here's going to be a massive compensation package. And obviously the Delaware issue is still in flux. We're going to give you a massive compensation package. These are the targets, everything that you talked about in the call. Okay, but you do these and the rest is history. But if you don't, as well as even some of the political stuff, that's something where I think the board needs to have a little more control.
Yeah, accountability.
It's accountability for the first time. And also, I think it's the most important chapter in Tesla's history, the next 12, 18 months. And that's even why I like Alphabet, like stepping up CapEx. The point is, no one in this AI arms race could be on the outside looking in. It speaks to why we say Apple's going to need to do perplexity. You can't be watching tech in the left lane of Ferrari going 100 miles an hour in that AI highway, being a minivan, right lane 45 miles an hour.
Right. King of analogies, Dan Ives. Dan, you're going to stay right there because we are going to turn to something you just mentioned, and that's Alphabet. Shares of Alphabet are rising this morning after initially falling as the company announced that increase in CapEx spending for the full year. It now expects to spend $85 billion this year. That's $10 billion more than the previous forecast. And CEO Sundar Pichai reassuring Wall Street that the investments are necessary to keep up with strong customer demand. Here with more is Mark Schmolik, Bernstein Internet Equity Research Analyst, and still with us, Dan Ives from Wedbush Securities. Mark, I want to get to you first because it is interesting that initially the street, the stock reaction was sort of negative to that bigger CapEx number, and then it seemed to be, okay, we're convinced that it is necessary and it's supported by demand. How are you thinking about it?
It's about time. I get the shock. It's a big step up. It's very ungoogly. The kind of $10 billion step up in CapEx. And I imagine some of the algos saw kind of the free cash flow compression, driven by that step up in CapEx as well. But this has kind of been a place where every single kind of mega cap has been talking about the risk of underinvesting is greater than overinvesting. And I think that's doubly true in Google's case, given kind of search is front and center and what they're trying to do with their cloud business. I think it's about time that they stepped up that investment. And, I think this shows a slightly different, perhaps more aggressive side on Google that, at least for my seat, was very well received.
And so what does this do for them? If I'm an investor and I'm looking at this increased CapEx spend, and where are they deploying it? What's the sort of ROI on doing something like this?
Yeah, I think for now the ROI looks really good, right? And you've seen that in kind of the acceleration in the cloud business, not just on GCP side, but kind of the bundling of Gemini into Workspace. You've also seen that on improving kind of core performance. Management spent a lot of time talking about engagement improvements on kind of AI overviews, AI mode, the Gemini app, et cetera, and how that's monetizing it, at least for now, AI overviews at a similar rate. So the ROI today looks really good. The question is, does that continue, right? How are they acquiring kind of GPUs and TPUs on the capital side? The allocation kind of seems to be kind of 50-50 between the cloud business and core. Does that mix continue on a similar dimension? So I think that's still an open-ended question. We're cautiously optimistic that current ROICs continue, but we'll certainly see.
And then Mark, on search, does this quarter show that the kind of rumors of the death of Google search have been greatly exaggerated?
This has kind of been consistent, right? They haven't missed a quarter in search since ChatGPT launched, 2.5, almost going on 3 years ago. This stuff takes a long time, and perhaps revenue is a lagging indicator. I know there's been a lot of focus on paid click growth, which also accelerated. But then we've got YouTube accelerating and improving as well. So we'll see what happens over the next 2 weeks when the rest of the digital ad sector reports. We think it's probably going to be pretty good for the entire sector. So it's more of a secular trend at the moment of just strong digital ad growth entirely. But this seems to be one of those things where it's kind of been, instead of slowly then all at once, it's kind of the opposite. It's all at once of all this fear and all of this behavior change. But then to actually shift behavior from here, shift dollars, like that's a much slower process. And in the meantime, I think Google search is executing very well on what they can control.
Right. Dan Ives, when you go to search something, do you Google it? Do you ChatGPT it? Do you Claude it? I don't know.
It's a combination. I mean, look, but I think those are great points. The reality is that you look at Google, they're back at the cool kids table. And they're stepping up. They're no longer in the corner, where the view is they're on the defensive, they're on the offensive. 10 billion step up CapEx, great numbers on search. I think there's a $25, $50 upside from here. And I think it just shows this is an AI arms race. You cannot be on the outside looking in. We've talked about it.
Yeah.
The AI party, 10 p.m. It was 9 p.m. That party goes to 4 a.m.
Right.
Last thing you want to be is on the outside of the party looking through the window.
Who's winning the party right now?
He's wearing a black leather jacket. The godfather of AI, Jensen NVIDIA. Next to him, obviously, is Nadella in terms of what we see in Redmond. Of course, Zuck and Meta in terms of what we see, especially as a wartime CEO. But it goes back to who's on the outside looking in. Apple's like, hey, can we get in the party, cook? You got to do an acquisition Perplexity to do something big. Tesla, transition. Alphabet, they just got, right now, Alphabet, they got let back
They
in
just
the
brought
party.
a case in. Everybody's happy to see
So the
that.
velvet ropes opened up,
Okay.
and now soon they're back on. They're in the dance floor with Jensen.
Mark, what's interesting to me is that looking at your note in reaction to those Alphabet earnings, you're still on a neutral rating or neutral equivalent rating, but you seem to be waiting for the signal to maybe get in there. What's that sort of last piece that would make you get a little more positive?
Yeah. Look, I think the debate has kind of been ongoing, not just about kind of AI, but just the changes in search, and is Google being aggressive enough at effectively recognizing it? To kind of use Dan's expression of showing up to the party. We use that in our note too. It's, they're fashionably late, but there's still some dance time left. So, we think there's still enough time, but they need to kind of continue this aggressive tone. You're looking at kind of the stock reaction here. That's pretty tepid after what is otherwise a pretty solid print. And, we've still got that remedy ruling tied to the search case that's just hanging over the stock. We expect that kind of ruling here in August. Yeah, really hard to own the stock in kind of in big size, kind of waiting for that through the summer holidays. So we'll see where kind of that lands, and then just whether Google can continue to be aggressive and take share in an absolute basis. All the numbers look really good. What we don't really know is what's happening from a share dynamic perspective. I think you just take a look at the top of the app download charts, and ChatGPT is still right there. So they haven't really gone anywhere. So yes, right at the moment, tide's lifting all ships, but we really want to make sure that we can get through these remedy hearings, that we can continue to see an aggressive Google, and that they can stem the losses over to ChatGPT.
And Mark, you mentioned the antitrust decision that's expected in the next month or so. We've talked to some analysts who say, break them up, it's fine. That Google actually will be okay, and maybe even better. Dan's shaking his head, but Mark, I'm curious to get your take on this.
Yeah, look, there's certain parts you could break up where it's the sum of the parts is greater than kind of the whole, and I think we've certainly gotten a lot of requests for sum of the parts analysis, and it's true, right? You do get that conglomerate discount. But the way you think about kind of where Google can get broken up here, particularly in the search case, the two assets on the table are Android and Chrome. You're talking about distribution of search. I think that's not something you can afford to lose at the moment.
I mean, I'd just say there's a better chance of me playing in the Ryder Cup than Google getting broken up.
You just think it's not going to happen?
I think, again, I view it as basically almost a 0% chance. But I get it. It's like, it speaks to some of the nervousness. But look, for our whole careers, right, there have been so many rulings, regulatory. If you focused on that, you missed so many of the biggest transformational tech stock the last 20 years.
Dan, while I have you, I got to ask you one last question. We've been talking about the Magnificent Seven for a while now. Is it time to lose that? Do we need a new grouping?
Look, I mean, it's one where it's like Mag 7, others have come up with other acronyms, but the reality is that these 7 continue to be so essential to the market in terms, and especially when you think about AI revolution, whether autonomous, whether advertising, and whether it comes to hyperscalers. Mag 7, they're still in that left lane, 100 miles an hour in a Ferrari.
All right, Dan Ives is sticking with the Mag 7. Dan, thank you so much. Mark, thank you very much. Really appreciate it, guys. We got much more coming up, including trending tickers. Stay tuned. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Ali Canal, live at the NASDAQ. Let's get a quick check on the market action about 1 hour into the trading day. You're seeing the Dow down roughly 220 points, or about 0.5%. Now, this is being dragged down by shares of IBM, Honeywell, and United Healthcare. We also are seeing a reversal in the tech-heavy NASDAQ composite. So we did open higher in the green. We dipped into the red. Now we're back in the green. This seems to be due to Alphabet shares. Alphabet shares opened up about 3% higher at the opening bell, but we are now seeing some of those gains be a little more muted, up just closer to 1% at this point. So we're continuing to track the moves in the tech-heavy index. And the benchmark S&P 500 is up roughly 0.1%. But I also want to take a look at shares of Chipotle, because they are just getting whacked in today's session. They are down around 12% after the company cut its full-year outlook. They also cited declining foot traffic and same-store sales. Now, executives said that they will be able to reverse those downside trends in the current quarter. We'll see if that prediction can become a reality. But that's bleeding through into some of these other fast casual and fast food names. McDonald's down around 0.6%. Starbucks, which we know has had a tough time with its own same-store sales, including that business in China, down about 1.5%. We're seeing Yum trade essentially flat. Shake Shack down about 1.5%. We've been talking about this bifurcated consumer economy, this potential K-shaped recovery that we're seeing among the broader economy, along with individual stocks. Is something that we're going to continue to track all earnings season long. But keep it right here on Yahoo Finance. We will be right back.
And let's talk about President Trump. He's set to join a tour Thursday of the Federal Reserve building, in D.C. The visit coming amid growing criticism of Fed Chair Powell over the central bank's renovations and interest rate policy. Here with more Washington correspondent Ben Worshkull. And Ben, this was an already scheduled tour, right? That some officials were going to be taking a look at the renovations that are ongoing.
Yeah, so this tour has grown. It's grown in size. And the big surprise we learned last night was that President Trump will also be visiting the Federal Reserve today. So all eyes will be on Constitution Avenue, which is where the headquarters are, at 4 p.m. when this is scheduled to take place. And this is a very highly unusual presidential visit. President Trump, I don't believe, has ever been to the Federal Reserve building itself. So this is a major change here. And it comes, as you mentioned, after weeks of this criticism over this $2.5 billion renovation that grew from $1.9 billion after it was approved in 2021. The focus here is on these renovations and these costs, as Trump officials are claiming that the changes are so dramatic that the Fed may have to go back to review this. So essentially get reapproval again on this project because they say the changes have been so big. The Fed has pushed back against this, says the changes are normal, and that it's not looking to get reapproval. But that's the clear technical standoff here, as well as the kind of court of public opinion element here of President Trump himself making a visit to the Fed in pretty dramatic fashion here. The overall mood music, as you mentioned at the top, is the interest rate fight here, which President Trump slams Powell on a daily basis, saying, excuse me, that interest rates need to be lower. But they're trying to use this element of the Fed renovations as one of many political fronts that Powell is going to be confronted with for weeks and months ahead if Trump holds off on firing him. That is going to make his life much more complicated for the next 8 months for certain.
Yes, definitely seems that way. Also, on the tariff front, we got an update from President Trump on the rates that are set to go in effect on August 1st. So what do we know about that?
Yeah, so we have some new comments from Trump last night on reciprocal tariff rates that set a new number that I think markets should be watching, which is 15% tariff rates on the world. He described a simple tariff rate of anywhere between 15 and 50%. So that's his new standard, and this is a real shift from even recent days. We've seen this 15% number pop up again and again. It was the centerpiece of the Japan deal we saw earlier this week. Auto tariffs are now 15% there, as well as on other goods. It's also what we're seeing the European Union negotiations center around, a 15% rate. This is a shift from 10%, which the European Union was focused on just a few days ago. It's also a shift from what Trump's team was focused on just a few days ago. Commerce Secretary Howard Lutnick said as recently as Sunday that smaller nations should expect a 10% rate, but now that's 15%. This all comes, of course, as the markets have shrugged off this number. 15%, I think, during the campaign was seen as a wild, unrealistic number. Now it's kind of good news for markets. The Nikkei went up after the Japan deal was announced, and comes as the markets is really focused on China, with talks there set to recommence next Monday and Tuesday in Sweden.
Yeah, it's all about setting and then resetting expectations, I guess, Ben. Sure. Thank you. Now time for some of today's trending tickers. We are watching Comcast, IBM, and Honeywell. First up, shares of Comcast moving on reports that NBC Universal is exploring the launch of a sports cable network to rival Disney's ESPN as early as this fall, according to the Wall Street Journal. The planned network would feature content also available on NBCU's streaming service Peacock, including NBA games, Sunday Night Football, the WNBA, and more. Separately, the New York Post reporting Amazon founder Jeff Bezos considering a purchase of NBCU's CNBC. Ali Canal is back with us here. And Ali, of course, you track the media industry closely, so it's interesting to get these sort of various threads.
Yeah, and it was very interesting and surprising to me a little bit to see this report, considering that we have companies across the media sector, including NBC Universal, that are actually moving away from linear television. So NBC is going to be spinning off most of its cable properties by the end of the year. Warner Brothers Discovery is doing the same thing. They will be separating linear networks from studios and streaming. Those are the growth drivers of their business. At the same time, though, we know what keeps butts in seats is sports. Right? That's really what consumers are tuning into on television. It's appointment viewing. We know NBC as a whole, they committed a lot of money into various sports leagues like the NBA, for example. And even a company like Netflix, which previously said it didn't want to be involved in sports, they've been doubling down on that as well. So the sports side of the equation makes sense to me. The cable network situation, I just don't understand how that adds to the value of this company, especially when we know linear network revenue has been consistently declining here. NBC Universal told me no comment to this report. They also told me no comment to the report that Jeff Bezos was considering a bid for CNBC. There have been other outlets out there that say he's no longer weighing that option. But Julie, nothing really would surprise me here when it comes to the media industry. Things are moving so quickly, so fast, and a lot of these companies are having to pivot just in order to survive here.
Yeah, I think as members of the media industry, nothing would surprise us either. Allie, let's talk about IBM, though. Software revenue there coming in below expectations during the most recent quarter, though headline sales and adjusted earnings per share topped analyst expectations. And on the earnings call, CEO Arvind Krishna mentioned that geopolitical tensions were causing clients to move cautiously, as he said. He also called out more constrained spending from the U.S. federal government, though he noted the company doesn't expect it to create long-term headwinds. A big tumble there for the shares, although we should mention on most metrics, IBM beat, and the shares have been outperformers this year. In fact, the stock within the last month has been at record highs.
Yeah, and if you take a look on a year-to-date basis, heading into this earnings print, we were up around 30%. So perhaps some of this good news already priced in, and we've seen that really across the board with a lot of these big tech companies, especially those with high valuations. You can just look at Netflix last week, which initiated a beat and raise on that report, and then we saw the stock decline. But like we've been talking about, IBM beat on revenue, margins, free cash flow. Gen AI growth also accelerated. In fact, at this point, over 10% of revenue is now tied to Gen AI. Wedbush analyst Dan Ives, who you were just speaking with on the program, he wrote that IBM's business flywheel is starting to accelerate. He said that he would be a buyer in any knee-jerk weakness. This morning, the firm did maintain its outperform rating and $325 price target on shares. But you did mention some of that disappointment on the software side. Software is the biggest piece of IBM's business, so maybe that's where investors are hinging their wagon to when it comes to the declines that we're seeing right now in shares. But again, the stock has been an outperformer, especially over the past month.
Right, exactly. And let's also talk Honeywell. It's lifting its full-year outlook for the second quarter row as the company continues plans to separate its aerospace automation and materials units. Honeywell is now expecting organic sales to increase between 4% and 5% for the full year. Earlier this year, Honeywell said it expected $500 million in tariff-related exposure. The shares there, Allie, down about 5%. But for a lot of those big industrial companies, we've actually seen outperformance this year.
Right, and we did see modest declines in operating and segment margins, some softness in industrial automation. Maybe that's contributing to some of the declines that we're seeing today. But when we talk about the eventual separation here of this company into 3 separate publicly traded entities, that has been a long time coming. There's a lot of talk on Wall Street that that's going to unlock value. It's going to be less confusing for investors. It's going to increase the focus on executives. And you can look at this space in general and how we've seen that in the past. General Electric, for example, last year they split their company into 3 separate businesses: GE Vernova, GE Aerospace, GE Healthcare. We just saw GE Vernova report solid earnings, shares soared. So still a lot to come for Honeywell. I will say, when we're looking at the declines in shares today, we're just up around 1% since the start of the year. So not necessarily an outperformer in this environment, but maybe down the line when the company separates, we could see a little bit more of a tailwind there.
Yeah, and I mean, the XLI, which is the industrials group, is up 17%. So definitely pretty big contrast there. Thanks, Allie. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trading tickers page. Coming up, we've got the CFO of Southwest following that company's earnings. We'll find out how the company's transition is going. Stay tuned. Southwest Airlines shares are under pressure after the company missed analyst estimates in its second quarter and issued a trimmed pre-tax earnings outlook. Joining me now is Tom Doxey, Southwest Airlines Chief Financial Officer. Tom, thank you so much for joining us. We really appreciate it. I want to start actually with the outlook because there does seem to be a little confusion on the street about it. It seems as though your net number, you did not change the outlook, but the pre-tax earnings outlook for the full year does appear to be trimmed. Can you clarify for us?
Sure. Well, first off, Julie, great to be here with you today. I'm excited about where we are here at Southwest and the transformation that's happening here. I think what you're alluding to is the various initiatives that we have and the contribution that that's bringing to our business. We've talked about $1.8 billion of incremental EBIT associated with those initiatives that will come in this year. That is still on track, and I think that's what you're referring to. That is things like bags, for example. That has been exceeding our expectations. We announced today that we plan to earn an incremental $350 million in 2025 due to bags, which is ahead of our expectation. If you put that on a full run rate for the year, that's $1 billion, and again, exceeding our expectations there. That's one of the items. There's other items there in the initiatives. That is intact, and we feel very confident about those items. Now, to maybe put that in an aviation example, we're flying faster, but there is a headwind that's out there, which is a broader headwind. Now, the good news for us is I think that domestically, if you look at what we're doing versus our peers, our large industry peers, we are actually performing better for domestic unit revenues than they are. So that headwind is not quite as strong for us because of that performance that we've had with that headwind that exists there out in the macro environment. But the kind of high level story for us is those initiatives are on track, our story's on track. We're flying into a bit of a revenue headwind in the industry. We're performing better in that headwind than our peers, and excited about where we're headed as we move forward.
And Tom, again, just to make sure I understand here, so the full year EBIT guidance or pre-tax guidance is for $600 million to $800 million, correct?
That's right.
And is that comparable with the $1.7 billion that was the prior forecast there?
Yeah, that's exactly right. And so there's an estimate of about $800 million to $1 billion in revenue degradation that has occurred as a result of the macro. And again, as you look at how that fits in the industry, you look at the numbers that were reported. I think the domestic number for American earlier today was in the -6 range. I think the United number was in the -7% range, and we're doing better than that. So for domestic revenue, we are performing better. Now, domestic versus international and versus premium on a relative basis hasn't performed quite as well, but within that domestic side of things, we are performing better than those other carriers. So the number is large, but it is macro driven, and it is in line or better than what we're seeing at our peers for domestic.
Gotcha, understood. Can you help me understand kind of what goes into that number, right? When we say macro, that can mean a lot of different things, right? What are you seeing as the various things that are feeding into that revenue degradation?
So we saw kind of in the first quarter and into part of the second quarter as well, we saw a lot of uncertainty. It happened pretty quickly. We saw some uncertainty that came in, and demand fell off quite quickly during that period. I would say that the speed with which that came down was one of the faster reductions in revenue that we'd seen in years across the industry. But it really is a result of uncertainty that was there. I think consumer confidence had come down. Now, the great news is we're starting to see that stabilize. I think as some of the things like tariffs and other things are starting to solidify a bit, you're starting to see that spending change. And what we talked about in our earnings release that came out last night, and this is in line with what you're hearing from some of the others as well, is that just in the last several weeks, we've started to see that turn back up, which is a great thing for us. And again, the fact that we had seen more weakness on the domestic main cabin side, which is where we're currently overweighted, the ability for that to then turn around as we move forward has the potential to create a really nice tailwind for us in particular as we move through the rest of the year.
It seems like there was also a little bit of rockiness around the changeover of sort of your fare structure, right? That it sounds like that's something you guys dealt with in the last quarter, and it seems like that's continuing into this quarter. How long do you think that adjustment period is going to last?
Yeah, it was actually very short-lived. We talked about a 0.5 point of unit revenue impact in the second quarter that we've just reported on, and then 1 point of unit revenue pressure in the third quarter. But it's not that it's ongoing. What it is that there was a period of time immediately following, and it was relatively short-lived, but a period of time immediately following that cutover where there was an adjustment. And what it really had to do with was friction in the booking process. You all have gone out and have booked flights, and you've seen if there's a basic economy fare that you're buying, we, as well as other airlines, want to make sure everybody knows exactly what it is that they're buying. And so sometimes there's a checkbox here, or there's a screen there. And so we were finding that there was more friction in the booking process than there needed to be. And we wanted to make sure that our customers were understanding what the product was. And as we made adjustments with that, we found that it recovered quite quickly. But during that period, the bookings that would have occurred during that period, some of which were for flights in the second quarter and some of which were for flights in the third quarter, it created that impact for us. So it's not that the impact of it is ongoing. It's that the impact that occurred during that time immediately following the cutover pertains to flights both in the second and third quarter, and that's what that number is.
And then, Tom, finally, just quickly, you guys are obviously making a lot of changes as we've been talking through, right? Seat assignments also are coming to Southwest for the first time. You guys are charging for bags now, which, as you said, was a successful initiative. What makes Southwest Southwest now? How do you think? How should consumers think of Southwest? Right? I remember a very long time ago when you guys had your first transatlantic flight. My sister was actually on that plane, and she got like a frozen turkey or something because it was on Thanksgiving. Like, Southwest is kind of known for doing these sort of fun things. What makes Southwest Southwest now?
I love our new TV commercial that we've just put out about assigned seating. I love the end of it, which is a bit of a spoof on ourselves, where you've got two people sitting at the bar, and one of them says to the other after this commercial about assigned seats, he says, "Oh, it's amazing no one's ever thought about this." And the guy kind of looks at him and says, "Well, I think what makes Southwest Southwest is that spirit that we have, that ability to poke fun at ourselves at times, but it just feels different when you're on our airplanes." Now, in addition to that, on the business side, we are the largest. We carry more people in the U.S. than anybody else. We have this amazing point-to-point network. You don't have to connect in busy hubs and fly on small airplanes. And this massive point-to-point network that we have that goes along with this amazing culture and this amazing spirit. And that is not lost. That our people are a huge differentiator. And when you combine that with a network like we have that is so unique, that is what makes Southwest different. You mentioned bag fees. For 4 decades plus, we were a very different airline before bag fees were ever a thing. And we'll continue to be a very different airline as we move forward.
Tom, really appreciate your time on what I know is a busy day. Thank you.
Thank you.
Coming up, we'll hear from the CEO of T-Mobile. Don't go anywhere. T-Mobile shares seeing their biggest gain in 6 months after the nation's second largest wireless provider reported an increase in new subscribers. Our own executive editor, Brian Sozzi, sat down with the CEO.
Things are becoming a little bit old hat over at T-Mobile. Another quarter of earnings beats and an upbeat conference call. Let's bring in T-Mobile CEO Mike Sievert. Mike, maybe this doesn't feel like old hat to you, but as someone who's been covering T-Mobile and your leadership for several years now, I can't say that I'm surprised. But there has been a lot of competition in this industry. You always tell me there's always been a lot of competition, but right now there really is a lot. Help us understand this earnings beat and the upbeat nature of that earnings call that I just watched.
Well, it's great to be here, Saz. You're right. I mean, there are great quarters, but then there are great quarters. I mean, this was an all-time record Q2 for customer growth, both on total postpaid and postpaid phone net additions, both on gross adds and net adds. I mean, it was just a trifecta on growth, and it resulted in postpaid service revenues up 9% year over year, by far the industry best. And that, to the premise of your question, is in a really competitive environment. That's how we like it. We like it really competitive because that means there's more jump balls. And when there's more jump balls in the air with consumers, T-Mobile takes a disproportionate share. So we're very comfortable with this competitive environment, and you can see it not just in the growth, and this is important, but in the value creation, because the quality of our customers and the financial returns we're deriving are also on the rise, which I think should satisfy people who would have concerns about overheated competition.
Mike, people are going to come, they're going to look at this quarter on Yahoo Finance, they're going to compare to what AT&T reported, what Verizon reported. Now, I don't want to dump on anyone here, but Verizon lost postpaid customers in the quarter. You gained a hell of a lot of customers. For the average human out there, why do you think you are essentially taking customers from a Verizon?
Well, the industry is dynamic, and one of the things that we've been very careful to do, and it happens over years, not months or quarters, is to develop durable, long-term advantages. And, we've talked about this before, but T-Mobile has maneuvered itself into a position where it's unprecedented that one company can simultaneously offer consumers the best network, but also the best value. And you've always had to pick one or the other in this industry before. And so when you can simultaneously offer both, it shouldn't surprise anybody that same company, will round up the customer growth.
Would you characterize competition as overheated?
No. And you can see it in the data. Industry cash flows, Brian, are up 50% from 2022. That's not an overheated situation. That means this whole industry is making more money than ever. And you might say, well, is that on the backs of customers? Also, no. Customers are paying less in real dollars than they were in 2019. They're having 3 times more data at 4 times faster speeds. That's the 5G dividend. Everybody's winning. But this industry is more financially successful than it's ever been. And those that say it's overheated on competition just have to look through to the facts.
So, Mike, I'm reading this earnings release. I watch the earnings call like I always do. You can watch it on YouTube. Very fun to watch. But I couldn't help but to think to myself, why isn't T-Mobile raising prices more? Can't you do more to boost your bottom line, just given the momentum the company has had? And how come you don't do that?
Well, part of it is customers are self-selecting up our rate plan on their own. We don't need to when they're moving up to our higher end rate plans because they want more of what we have to sell. I mean, what a great place to be. I disclosed today for the first time that within our premium segment, the ultra premium, the highest rate plans we offer that are packed with the most value for customers have doubled in their popularity over the past year. I mean, that's amazing. In 1 year, they've doubled in their popularity. So people are moving up our rate card on their own. Now, at the same time, this year, we did do some rate plan optimizations. First, we finished a program we started last year, first of its kind in a decade. And that, that's moving its way through our system. But we're judicious about that. We don't rule it out. We're open-minded about it over the long haul. But I'd much rather attract people up the rate card with fantastic value.
One concern I've heard from contacts, Mike, in the telecom industry is the industry is being so competitive right now, it's costing more to get customers, therefore lowering the return on this investment. How would you respond to that?
It's not true. The investment in customers is higher on the device side, but also ARPUs are higher, and customer length is higher, and customer length with any given device is higher. And so when you put all these into the equation of customer lifetime value, our customer lifetime values on a per customer basis, what we get for what we pay to acquire, is remarkably consistent. What they're looking to is one subset of the competitive milieu, the device promotion, which has changed. It's gotten hotter on devices, but that's just because the nature of what customers are looking for changes over time. On the rate plan side, we're monetizing it at a higher rate than ever before, and it all kind of comes out in the wash. And again, you can see that in cash flows.
This week is launch week for the Starlink service. What have you seen in the early going here?
Well, first of all, thanks for asking. We just launched it this morning at 8 o'clock, so we don't have a big update for you. But look, this is a differentiated service. This is, 550 plus satellites in the air, transmitting at any given time that automatically connect to your cell phone should you happen to fall off cellular networks. And it's not just available for T-Mobile customers. It's available for everyone. Just come sign up, and it's as little as $10 a month.
But have people signed up?
Absolutely. And they signed up during the beta process, so those customers become paying customers right away. But one of the things that's happening, I told you a minute ago that people are moving up our rate card because they want more of what we offer. this is one of the dynamics, because our Experience Beyond plan, which is our premium plan I was discussing, includes T-Satellite for free.
Intel is set to report earnings today after the close as new CEO Lip Bhutan looks to turn around the struggling chip giant. Here with what we should be watching for in the report is our Dan Howley. So Dan, what should we be looking for from Intel?
Yeah, I mean, like the numbers are kind of, an afterthought at this point, but we'll just go over them. They're expecting EPS of 1 cent on revenue of 11.8 billion. That would be down from 2 cents and 12.8 billion last year, or this quarter last year. That's really kind of the side story at this point. The main story is, what is Lip Bhutan doing with the company? What does he see going forward, and what kind of commentary can he give us there? Are they going to be continuing to stay in the third-party foundry business? They're trying to build that up. Are they going to back out of that? He said that they're in foundry to stay. Then there's the other thing, their 18A node. That's supposed to be the big chip that Pat Gelsinger, the prior CEO, was really pushing. There's been reports that they're going to no longer offer that or move away from offering that to third parties for them to build their own chips and instead move to 14A. That could mean billions of dollars in write-down. So we really just have to see. But it's less about the numbers this time around and more about the broader story of the company and what the new CEO is going to be doing.
Yeah, that makes sense. While I have you, I want to talk about yesterday in Washington and President Trump's new executive orders on AI and just this focus on AI regulation or lack thereof, depending on how you look at it. What are some of your thoughts on how that played out?
Yeah, I mean, obviously the companies are happy because they want less regulation so they can basically kind of build how they want. And I think the idea of the patchwork laws that they have for states, it's the same kind of thing with cybersecurity. It's a patchwork bunch of laws. So, the idea that there's going to be penalties for states that have their own potentially onerous laws according to the companies, I think that that's interesting. The idea of the woke AI and excising any kind of bias out of AI is interesting. The reason being is anybody that I've spoken to has always said, sure, there's bias in AI. There's no doubt about it. But it's not because of someone's specific goal.
It's because everybody's biased and that's the information that they're taking in,
exactly.
presumably.
It takes in information.
Humans have biases.
Humans have biases. They then can go ahead and adjust it, but they're still people. And so it's any kind of information is going to be biased regardless, and that's kind of the big takeaway. And then on the side of, okay, so how do you get rid of that? Well, you don't, because it's very difficult to take bias out of these. And even if you want to look for particular instances, right? For instance, if you believe that something is too right-wing or too left-wing, and you try to excise that, well, it's not exactly that easy. We've seen what happens when companies try to go in and fiddle with things like with X did in Grok.
Yes.
So it's not exactly a,
tricky,
taking out a bad tooth.
Right. Dan, thank you. Appreciate it. Coming up, we got full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. Coming up this hour on Market Catalyst, first up, amid the meme stock rally, we'll dig into the fundamentals of the stock that kicked off the retail frenzy. Full analysis of Open Doors coming up. Plus, Alphabet reporting strong demand for its AI products, a check-in on the winners and losers of the AI arms race, and we'll have full market coverage ahead as U.S. stocks trade at record highs. All that and more coming up on Market Catalysts. 90 minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets here as we take a look at the major averages. We have been seeing a mixed picture throughout the session here, and that continues. The S&P and the Nasdaq each rising about 0.25%, and both of them on track for record closes. The Dow, though, has been the laggard throughout the day, although its losses have lessened a little bit as we've gotten into this early session. Right now, it's down about 0.25%. The current meme stock mania can be tied back to a post from our next guest. That's Eric Jackson, EMJ Capital founder and president, writing in a post on X on July 14th that his firm was taking a long position in Opendoor, which was then trading under $1 a share. He said later in the thread that the stock could hit $82 a share based on the fundamentals. Since then, the stock is up nearly 200% as retail investors have piled in along with Jackson. He's joining us now to break down his bull case for Opendoor. Eric, it's been a long time since we've talked. It's great to be connected again.
How you doing, Julie? Good
I'm
to see
doing
you.
all right. Good to see you too. So first of all, I should ask, are you still in Open Door? I mean, obviously depending on when you got in, you've done pretty well with this recent rally.
Yeah, no, I am. I'm ride or die to 82. I mean, not, obviously I'm, it's not like I got married to the stock. I mean, if I, suddenly saw that the management team was making terrible moves or whatever, I would change my mind. But I think the reason why I'm so excited about Open Door is that I don't think it's a meme stock. The post predates all this meme stock mania. Carvana wasn't a meme stock. And Open Door is not a meme stock. This is a real turnaround, legitimate turnaround story. It's an opportunity for anybody who missed Carvana. And I missed it at 350. I got in at $15 on Carvana. So I think I do know what to look for in these kinds of situations. And I think that this is the ground floor for a move to 82. So, something could happen to change my mind, but the plan is to stick with this and sit on my hands and let this thing compound.
So for people who maybe just have seen it as a meme stock or don't know what it is, this is a mobile platform for buying and selling real estate. Zillow was in that business and got out of it because they weren't making any money on it. And, at least if I look at the average Wall Street forecast, this thing is not expected to make money as far as the eye can see. So what are you seeing here? What's your bull case?
Well, I mean, nobody thought Carvana could make money. There was a time where nobody thought Uber could make money on a large national or international platform basis. So it's not unusual when you kind of e-commerceify or webify some kind of previously large fragmented industry plagued with kind of legacy kind of ways of purchasing, whether it's the agents in the case of real estate or the dealers in the case of cars and Carvana. So iBuying is difficult. It's tough to make money. And I have been bullish on Open Door before and have been wrong because I have been too early, which is the same as being wrong, because this thing has taken much longer since Powell raised interest rates and made it much, much more difficult to kind of get this thing to a steady state profitability. And so the reason why it got to 50 cents a few weeks ago is that Wall Street and most investors assume that this thing was just going to go, file for bankruptcy. It's not going to make it, just like what happened with Carvana in 2022 when it goes from $400 to $350. So I don't think it will. I think they are going to have earnings in a couple of weeks, and they're going to announce like their first EBITDA positive quarter in about 3 years. And they might not guide to kind of profits forevermore, but I think they're going to give some hints in that direction. And I think basically this is a business on the road to, within 6 months, steady state profitability. And the turn in the stock always comes before the proof that a company has reached steady state profitability. So I might be wrong. I've been wrong before about Open Door, but I was wrong about Carvana. I didn't jump in at 350. I jumped in at $15, and that I still did great. But this time I'm sort of leading with my chin more and saying now's the time to buy. When it was under $1, it's still at $2. People say, "Oh, I missed the move, Julie. Oh, Eric, tell me about tweet me the next one." I mean, we're talking about a stock that could go to $82. You didn't miss the move.
I guess I would love a little more clarity on like how this turn happens, right? Yes, the Fed might cut rates, but how does that then get this company to profitability? Like, what needs to happen?
Well, what's happened in the background for the last sort of three years is that Carrie Wheeler, who's the current CEO, took over for Eric Wu, who's sort of like co-founder, first generation CEO. She's been cutting. She's sort of like more comes from a banking, private equity background. Cut. Get the fixed cost out of the business. Not dissimilar to what Carvana did, and get this business to the point where we can even make money at iBuying at the current interest rate levels. They got thrown for a bit of a loop last year when Powell kind of paused on cuts, and so they had to cut more. Cut. So what happens is they can make money they will make money this quarter probably, at these rates. but their business is now set up for, with a little bit of easing, with a little bit of a decline in interest rates, which I think is it's a sure thing. I mean, maybe something happens and a Powell kind of, tariff wars explode or something like that. But I think, most of us think 99%, interest rates are going to drop. Volumes increase, and the current platform that now exists at Opendoor can push a lot more business through it, make a lot more money than Wall Street currently expects. So that will be a huge tailwind for the business that no analyst on Wall Street is sort of counting on when they kind of look forward and make their estimates for this business in future years.
Eric, you said before it's not a meme stock. You believe in the fundamental story. Is it a bad thing that it has become a meme stock in the eyes of a lot of retail traders? In other words, like if everybody's excited about just sort of trading it or short squeezing it or what have you, is that sort of counter to what you're trying to achieve?
Well, I take offense to the meme stock characterization because I've yet to see a meme stock, and because I don't include Opendoor amongst the group, that is a real business. I think these meme stocks are dumb businesses. I would never want to own a donut business. I would never want to own GoPro. I don't think we're on the cusp of some GoPro resurgence, and everyone's going to be walking around with GoPros on their heads, the way that we thought when they initially IPO'd. So why people get caught up in that, that's not me. I don't even think GameStop was a real business. Although you could, obviously initially in the early days, it was a value play and a high short interest and all that kind of stuff. Yeah, that's sort of the most believable. But today, why would I? There's other Bitcoin treasury businesses. Why do I want to own a dying retail chain? So Opendoor, I think, is a real business. Is it bad that you get the flippers? Well, like a couple of days ago, we sort of like almost broke the markets when Opendoor surged like 120% and almost touched $5, when a lot of shorts would have had to cover, by the way. And then suddenly the NASDAQ halted it. And then there was sort of like mass confusion. On that day, 1.9 billion shares of Opendoor traded. 723 million shares exist. That's the total shares outstanding for Opendoor. So the next day, 1 billion shares traded. Yesterday, about 500 million shares traded. So obviously, there are flippers here. I think, I don't understand it because I still think we're in the early innings. I mean, everybody's got to make their own investment decisions for themselves. But I mean, I did put out a tweet this morning that said, wouldn't it be interesting if all retail shareholders, all institutional shareholders, if they buy this argument that this is the next Carvana and this thing is going to 82 and we're on the ground floor. Imagine if they just put all their energy into buying the stock and holding it. If they did and didn't flip out every 2 hours or whatever they're doing, this thing would have a Cisco.com era type of an explosion. It would be a supernova event. GameStop would pale in comparison to what's possible if we applied the Wall Street bets crowd to a real serious turnaround business. So maybe people will think about that. I mean, I'm not counting on it, but it's a real.
That would be great for you, though. If that's what happened, Eric. To be clear, it would benefit you. It would benefit you as well. Just real quick, before we let you go. Anything else you've got your eye on now that's going to be sort of your next bet here?
Well, I mean, two stocks I mentioned before, Opendoor, which gave me kind of the idea, that, I think there's an audience for the next Carvana with Opendoor. But two other next Carvanas, which I own, Iron, IREN, and Cipher, CIFR. They're both Bitcoin miners. They make a lot of money from mining Bitcoin right now, but they've moved aggressively years ago into the AI HPC business, similar to what Core Scientific was doing, but these two are much bigger. They have much more in the pipeline. They each have 3 gigawatts of AI data centers, which they have built or are building, which are going to get energized in the next 12 to 18 months. And I think Brian Sozzi this morning was like tweeting out like the massive shortage for these AI data centers for power, for getting connected to the grid. These two stocks have those connections. They have the gigawatts. And I think there's going to be a massive re-rating in them. They could 100x each themselves.
We'll be watching those too. Eric, thanks a lot. Appreciate it.
Yeah, great to be with you.
Let's continue the meme stock conversation. A lot of retail investor trades are made on Robinhood's platform, so we want to get the inside scoop into the actual trading activity around these stocks. Steve Quirk is with us, Robinhood Chief Brokerage Officer. Steve, it's good to see you. You just heard Eric Jackson saying he doesn't want to think of Opendoor as a meme stock, because that implies there isn't a fundamental case here. But like, whatever you call it, people are piling in. I mean, we've seen meme activity clearly with a new crop of names. What are you guys seeing?
Yeah, we're seeing the same thing you're mentioning. Thanks for having me, Julie. I actually think we're at a point here where, what is this, the third iteration of what we're calling the meme stocks?
At least.
Yeah, and if we actually go back, farther, we could argue there's probably been many more. We're at a point where, if we look back at Liberation Day and the rally that's happened since the bottom there, we're up like close to 30%. And in some of the more popular names that our customers trade on a more frequent basis and invest in, NVIDIA's, Amazon, Tesla's, and those, could be more. So I think what you're seeing here is people taking some of those profits and saying, hey, there's some stocks here that are interesting. They're all pretty much sub $5, so it's not like they're spending a lot notionally, but they're kind of drawn in by the volatility. Retail customers like to dabble around in stocks that have the kind of movement that we're seeing in these names. And so if we just look at the top 100 traded symbols, and this applies to both equities and options, none of these were in the top 100. And now they're all well in the top 25. And Opendoor made it all the way to 2.
Wow.
But they're still not the core of what our customers are mainly investing in and trading on a daily basis. They're called, I would call it more episodic.
Gotcha. How long do these episodes tend to last?
As I think, we've already seen, that there's been a rotation even in the ones that have been the most popular. So, I can't say with any certainty how long they last, but they do tend to turn over rather quickly. I think what's interesting is the way that people are approaching it this time. It's not dissimilar, using Reddit, social media, and other avenues to sort of share information, but I've been also reading that a lot of people are using large language model, ChatGPT, to say, okay, show me the next stock that's likely to quote unquote meme, which is kind of interesting because to me, it's, retail trader is always looking for an edge in anything they do, so that it can be competitive and, do well in the market. And any new tool that helps them do it is something they're going to play with, and hopefully that helps them down the road. It's kind of cool.
So the latest one we've noticed is American Eagle. Do you think that's ChatGPT generated, or is it all because of the Sydney Sweeney partnership?
Yeah, boy, I'm probably not the right one to ask. I should ask my daughters on that, but I would guess that's more of the Sydney Sweeney than the ChatGPT, but I could be wrong in that capacity. The other thing I'd say is, to me, and this even happened when the original meme stock, and I'm going to say 2021, happened. We looked at how many of those customers that came here exclusively to start trading, and investing in these stocks, young people, were still around Robinhood, and it's like 80 to 85%. So what I like about it is it doesn't really matter how you enter the market. It's more important what you do once you get into the market and how you start to invest. And they'll probably be angry for me for sort of outing them, but a lot of the people that started in those years now have retirement accounts, and they're putting money in our cash sweep accounts to get for 4.5%, 4%. So they've sort of expanded their investing to be something that might be a little less interesting than the volatile period and volatile
I love it.
names.
Interesting is a very diplomatic way to say it, Steve. And this really touches on an important point, I think, that I wanted to ask you about, this sort of entry-level trading, this current wave that you're seeing, this current episode that you're seeing. How many of the folks, is there a way of quantifying the volume around these new meme stocks? How much of that is new accounts on Robinhood?
I don't think we're seeing a real large percentage that's new accounts, but it does tend to resurrect people who maybe haven't been as involved in the market. And by the way, the same thing applies on the crypto side. And that's very much a price-driven asset class, whether it's in native crypto, which we offer, crypto futures, which we offer, or even the crypto ETFs. We tend to see a lot more activity when we hit certain price points, and that translates into broader engagement across all of their portfolio.
And Steve, finally, I would ask, as somebody who's been at this for a long time, when you see this kind of activity, there's a little bit of a debate over whether it signals an overall, overly frothy animal spirits in the market. What do you think?
At least in my experience, and I've been doing this a little too long, I think, but I really enjoy it. Now I get to do it with a much younger generation. I do think you tend to see things like this when we've gotten, to a point where we've seen, we started off by talking about it, like we're 30% off, up from that, from the bottom there, and that's a pretty substantial rally in a not that long of a time. So, I think it would be healthy for the market to pull back a little bit, or even, build a foundation if there's another leg to go up. And this does tend to happen when you get to these levels.
Steve, great to see you. Thank you.
Thanks for having me.
We got much more markets action coming up. Stay tuned. You're watching Market Catalyst.
The S&P 500 is up nearly 30% off the April lows, and Wednesday we took a look at cyclicals versus defensive sectors and how those poor defensive have gotten no love recently. Today I'm going to show you how to play these two different groups with an introduction and a way to enhance your portfolios with commodity futures. But first, let's do a brief recap of some of the basics that we covered yesterday. First, we want to take a look at the defensive sector definition. These are industries whose demand stays steady and booms or bust so that earnings and share prices move less with the economy. They're stable, in other words. And these we have four sectors: consumer staples, we have healthcare, utilities, and energy. And yes, energy is kind of a gray area, but we talked about that yesterday. Now we also have the cyclicals. These are industries and groups whose sales and profits swell in economic expansions. They shrink in recessions, and that makes their stocks swing more than the general market. And here we have the remaining seven sectors, the large cap sectors, at least that we define the S&P 500 by: consumer discretionary, industrials, materials, financials, tech, communication services, and real estate. And yes, there are some gray areas there too, especially with tech and communication services, but we move on. I just wanted to show this chart again too, because I think it's so incredible. This goes back to 1990, and this shows you the defensive sectors, how much they took up as part of the S&P 500. They started out at 40% in 1990. They moved up a little bit, but now they are at 20%. And then you take a look at two stocks only. This is NVIDIA and Microsoft, and they are now taking up 15%. So this just illustrates how much these stocks have become unloved, those defensive sector stocks. So as promised, I'm going to show you some ETFs on how to play. And by the way, a lot of this work comes from Todd Sohn over at Strategas ETF Research, and these are his basket here. So here we have a bunch of cyclical ETFs, starting with ARQ. That is the ARC Autonomous and Innovation Fund, not the innovation, the ARC Autonomous and Robotics Fund. That is up over 66%. That's twice what the S&P 500 is up. And then we have two ETFs that cover the semiconductors, SOX, which you might know, and XSD. Both of those also up almost 2x the S&P 500. Then we have high beta. That's up 50%. What is beta? That's almost like the stock trading at a multiple of the general market. So a beta of 2 is twice what the S&P 500 is doing. Those are doing well. Those are cyclicals. And then it's interesting. We have a broker-based ETF. That's up 43%. And here's the year-to-date, still holding on to gains of 21%. So we do have financials in there. Then we have another one, KBW Bank Index. That's another financial-driven one. Then we've got some other interesting ones. We've got PAVE, which is infrastructure. And also we have IWM down there. You might know that as a Russell Russell 2000 ETF. So that's a very cyclically oriented index. And you can also break that up into groups. But we got to get to some of our defensives here. So PKW is a buyback fund. And so the top two in there, I believe, are Wells Fargo and PayPal. And yes, this is a defensive, but two of those stocks are arguably cyclical. So it just goes to show you some of the gray area that we're dealing with here. But stocks that can do strong buyback programs, they have a bit of defensiveness worked into them. Also, we have the RSP, that is the S&P 500 equal weight ETF. Since the market cap ETF is so highly weighted to those big stocks, this one is arguably a bit more defensive. You can see that's up 7% year to date. Then we have cows. This is a cash cows ETF. You'll see stocks like Nike and Ford at the very top of that. The theory being that cash flows, those strong cash flows, make those stocks a little bit more defensive, even though a lot of times they're classified as cyclicals. At the very bottom, the worst performer, XLV. That is a standard SPDR healthcare ETF for large cap healthcare and pharmaceuticals. That's only up about 2.2% since the April bottom. And it looks like I'm out of time here, so I'm going to have to show you how to add managed futures to your portfolio and help balance it tomorrow. But I do promise to do that. In the meantime, tune into the Stocks in Translation podcast for more market decoding deep dives. New episodes can be found Tuesday and Thursday on Yahoo Finance's website or wherever you find your podcasts.
Thanks, Jared. Looking forward to that managed futures breakdown. Let's turn now to the winners and losers of AI. Alphabet posting strong results in its latest quarter, but shares have been coming off the highs. So who is best poised to outperform? Joining me now, Shai Balor, Futurum Chief Market Strategist. Shai, thanks for being here. So the question that we sort of have been digging into is, who is winning the AI race, right? So Alphabet giving us, and I guess we're going to get this information incrementally all throughout earnings season, but what do we learn through the lens of Alphabet on that front?
Yeah, I know the market likes to treat Alphabet as an AI laggard among the Mag 7, primarily because they're over-indexing the short-term ad volatility that AI is going to bring. However, they're missing the bigger shift. In the new digital economy, to become a real winner, you need to own four things: the data, the chips, the distribution, next-gen brain. Alphabet has all four. They're one of the few that have all four. And we saw Google Cloud have an inflection quarter just yesterday where it's growing top line 32%, 21% operating margin. That segment alone is worth $500 billion. Add in the YouTube side, which also exceeded expectations, growing top line 13%. A lot of people don't realize that they actually have the leading streaming hours among all competition. Netflix is at 7-8%, YouTube's at 13%. So if Netflix is a $500 billion company, begs to ask, what's YouTube worth? So those two segments alone, or those three segments alone, are going to be worth around like 1.5 trillion. And we're not even talking about Waymo. So I think that the fears of AI cannibalizing their search business is overdone. Yes, it might ruffle a few feathers, something that hasn't been done in quite some time on the search business. However, it's going to evolve. And I think in that evolution, you saw it yesterday, where Google Cloud's inflecting, you're seeing Google Search still maintain $200 billion run rate. And I think that you're gonna slowly but surely see that Alphabet will be a major AI winner in next coming years.
Gotcha. Okay, so you got Alphabet on the one hand, you got Tesla on the other hand, where its bet on AI is a little more indirect right now, right? We'll have the question, I guess, put to the shareholders over whether they should invest in XAI. I guess you have some AI incorporated in Tesla vehicles, but what's the case there? Where do they fit into all of this?
It's a great question. So I think yesterday it was obviously less about what they reported and what they're actually building. And I think that there is absolutely an Elon tax in owning Tesla. However, it's worth paying because we get the front row seat for a company building the AI brain and body of mobility and robotics. And when we think about how much money is being spent on actual labor every year, it's in the trillions. So if Elon can deliver on this vision of building the neural network for mobility and robotics, we're talking, we're right now trying to argue if it should be worth 1 trillion, 1.2 trillion. It's going to be substantially higher if he conquers that.
Okay, but how big is that if at the beginning of that sentence, right? Because you're talking about a guy who has, Yes, he has delivered on electric vehicles, but that's really the thing he's delivered on successfully so far. All the other stuff is still in progress, and it's pushed back, and deadlines are changed, and the ball moves all the time. So, is it a bet on something that maybe could happen possibly? Like, how, do you know what I mean? How sure of a thing are we talking here?
I believe this is the biggest bet Elon's made in his life, cannibalizing his EV business.
Okay, it's the biggest bet he's made, but as an investor, do I want to partake in that bet?
I see what you're saying. So I think, again, like I referenced on Google, the 4 things you need to be a winner in the new digital economy, Tesla has 3 of the 4. They have the data, they have the hardware, they have the distribution, the millions of fleets of cars. The next gen brain is what they're missing. I do believe that XAI and Tesla merger is going to be inevitable, and once that happens, they have all 4. But like you mentioned, the timeline is the variable in the calculus on if Tesla's a good investment. However, if you go historically, Elon has delivered. The timeline, always just like iffy, and right now it's an eye-watering valuation. So it's a risk. However, if you think about the past 5 years, how much of these early disruptors have run up, have had multiple expansion? All of them almost. But Tesla is at the same stock price as you could have gone in 4 or 5 years ago.
Yeah.
However, they're positioning themselves to be a leader in these secular growth, and that's the greatest TAM of mankind history. So that, I think it's a risk and rewards there.
If you're choosing where to buy right now, I'll come back to the original question, which is who's winning the AI arms race. So we just mentioned 2 of them. There's a lot of other companies out there. Where else should people be looking in terms of who's winning?
So I think it's safe to say that NVIDIA will maintain their lead as the GPU engine in the new digital economy. However, I think that even after yesterday when Google was down, it was still presenting the best risk and reward among all of the big tech players because they're still trading at 20 times earnings. But it's going outside the Mag 7, let's talk ServiceNow. I think ServiceNow had one of the best prints this cycle so far. I think they're proving that they are not just a SaaS company anymore. They are actually monetizing AI at the enterprise level. They could care less about what kind of chip and model you use. Their nirvana is making data talk, then orchestrating it to the right model, and then they're gonna have the workflow do its thing, and then it's gonna orchestrate outcomes. And I think that it's safe to say yesterday, it's proving that they're not a SaaS company, they're actually more of the control tower of AI. And knowing that kind of mindset of what company that ServiceNow is becoming, that's a massive runway. And I think we spoke to Bill this week and we spoke to their leadership team. They are gloves are off right now on them becoming the stage 2 AI winner. Everyone talked about Palantir, rightfully so. They're converting LLMs to real world decisions. However, I do believe that ServiceNow is becoming the workflow engine of enterprise AI, and yesterday proved that the re-rating should continue.
Yeah, and those shares, we've been seeing them go up. Thank you, appreciate it. Well, before we head to break, let's get a check-in on shares of C3 AI. Now that stock is falling. The company says it is beginning the search for a new CEO. That's after Thomas Siebel said he intends to step aside due to health issues. The company's hired a search firm to find a successor, which will then report to a search committee consisting of board and management members. Siebel intends to remain as CEO until the board appoints his successor here. Again, those shares are lower right now by about 10%, but under his leadership, we have seen that company certainly grow. Well, we've got much more ahead on Market Catalyst. Stay tuned. Now time for some of today's trending tickers. We're watching Blackstone, Bloom Energy, and Union Pacific. First up, Blackstone rising after a top and bottom line beat in the second quarter. The firm reporting a 25% jump in distributable earnings boosted by profits from the firm's retail and evergreen funds. Despite tariff uncertainties, resilient investors are propelling equity markets to record highs, allowing firms like Blackstone to capitalize. Fee-related performance revenue more than doubled to $472 million. Next up, Bloom Energy soaring on a deal to power Oracle's AI data centers. Bloom will provide fuel cells to supply on-site electricity capable of being deployed in 90 days. AI data centers require a lot of energy, and traditional grids can take years to connect new facilities, whereas fuel cells on-site can bypass some of those delays. Bloom systems also deliver this power with what they say is virtually no air pollution and no water use. And finally, Union Pacific shares are falling after the company confirmed it's discussing a possible merger with Norfolk Southern. The two companies releasing a statement saying there are no assurances that a deal will be reached. They don't intend to make additional comments or provide updates until it's appropriate. A combination of those two railroads would create one network connecting the East and West Coast. A Bloomberg intelligence analyst says that U.S. approval for a merger would likely be a big hurdle, putting the probability at around 30%. Union Pacific, by the way, also reported quarterly results with operating revenue essentially in line with estimates and a beat on adjusted earnings per share. Norfolk Southern shares are little changed. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Coming up, our conversation with the CEO of ServiceNow. ServiceNow is bullish on the future of AI, the cloud platform company boosting its full-year guidance thanks to robust demand for artificial intelligence. Executive editor Brian Sozzi spoke with ServiceNow CEO Bill McDermott about what's next for AI.
The AI revolution is in full flight. 92% of companies will be investing in AI, and they're going to increase their AI investments significantly by the end of the year. I think what you have to think about with ServiceNow is we are the only one in our industry that is taking on cross-functional work with AI. And the reason that some companies haven't gotten what they wanted out of their AI investment is if you buy AI for a functional silo that already doesn't integrate with the other silos, now you just have an unintegrated silo with unintegrated AI. We're the only one that does cross-functional work with AI going across the entire company. So if you think data is the fuel that needs to be harvested in an AI platform, then it has to go across a platform that serves all the functions. Otherwise, you'll only get incremental improvement at best instead of exponential improvement and growth, which is what you get out of ServiceNow.
How are you seeing jobs being changed inside of companies because of AI?
Jobs will absolutely change. I think one of the big things that people haven't tangled with yet is the idea that the 20th century org chart, just like the 20th century software industrial complex, is going to come apart. And it's going to consolidate on a platform like ServiceNow. And the reason for that is pretty simple. Work doesn't get done functionally. You know, think about business processes: order to cash, procure to pay, hire to retire, design to build. These are all processes that require multiple functions involved in the flow of that work. So if you have an agentic AI platform, why possibly would you think of just doing an agent for a department when you can transform a corporation? Why would you continue to add headcount to a function when you can get people to work together in teams and team up with their AI platform to transform your business? Whether you're improving OpEx, getting a new margin profile, or inventing a new business model and a new channel, you have to think differently. So as companies really grapple with what's possible, they're going to go for ServiceNow because we respect all the other investments. We integrate with their systems of record. We integrate with their data sources. We integrate with all the hyperscalers. We integrate with all the large language models, but we put it together in a business solution end to end. And that's where the market's headed. That's where org charts are headed. That's where headcount is headed. And we are retooling people in ServiceNow University. We've got 3 million people we're training now. And everyone's welcome to ServiceNow University. We're doing Rise Up in different parts of the world that haven't been initiated yet. Even in rough areas where they don't have the investment, we're getting in there to help people because we want to put AI to work for people. If it doesn't help people, if it doesn't help society, we're underselling its true capability.
Bill, you and I have talked for many years, but this was really, I think, the first earnings release from a ServiceNow. You mentioned CRM a lot in this earnings report. You talked a lot about agents, and really the only other company I've talked to that has mentioned some of these things is a Salesforce. Are you taking market share from Salesforce?
Yes, we are. And it's not just because we're singling out any company. Agentic AI is an extinction level event for traditional CRM systems of record. 90% of the market's going to move to a system of action with a front end autonomously led by agents. And so that's where ServiceNow comes in. And what happened is we realized that companies had a terrible experience with order management. If you think about a complex product SKU or complex pricing paradigms based on volumes and other things, to mix and match, configure, price, and quote large systems can sometimes take up to 8 days. We do it at sub-second speed now with Logic AI, which is the best configure, price, and quote tool in the world, all AI driven. And we just got them. We acquired them in June. We already wrote 9 orders, like in the last couple of weeks, just because we got them. So now customers are saying, wait a minute, I could do order management with you. I could do fulfillment with you, and I can service my customer all on one common agentic AI platform, ready to scale today, and I don't have silos and separate clouds and complex stories to deal with. Yep, you figured it out. That's ServiceNow. And that's what the customer wants. So yes, it's going to happen. And it's only natural that it should happen because we were built for this moment.
Back in April, UK-based Ineos Automotive said it would be capping tariff price increases at 5% on its vehicles, calling on politicians for urgent and direct political intervention on tariffs. In 2024, the company sold a majority of its vehicles in the U.S. and is aiming for 50% growth in sales this year. Now, the U.S. and EU negotiators are narrowing in on a potential trade deal that could see imports, including autos, tariffed at 15%. For more on how the automaker is planning for growth amid that tariff and trade uncertainty, let's bring in Lynn Calder, Ineos Automotive CEO, also with us, Yahoo Finance senior autos reporter Pras Subramanian. Thanks to you both for being here. So, Lynn, let's talk tariffs a little bit first, and then let's dig into the growth scenario. You all are, and we should mention you all are a higher end luxury automaker here. So that's sort of the base case as we talk about what effect tariffs will have. But where are most of your vehicles made, and then how are you dealing with the tariff situation?
So we found ourselves right in the eye of the storm, Julie, because whilst we're a British company and a complete British backstory and legacy to our brand, we are produced in France. So even once there was a tariff deal negotiated as between the UK and the US, that meant nothing for us. So we're still now waiting very patiently for European politicians to announce a deal to help us with our factory in France, exporting from there into the US, where, as you say, it's our biggest market.
How are the U.S. sort of consumers reacting? And you mentioned that 5% cap rate on the price due to tariffs, which are 25% sector tariffs in the auto for autos, which is kind of a big deal for a car even that costs $80,000, $90,000, $100,000. How are they reacting to that, and also the new quartermaster that's out too?
Yeah, so I mean, first of all, like taking a step back, I mean, the US is reacting so well to our vehicle. It's our biggest market. This is a country that's really adopted our vehicle, which is really exciting for us. It just fits. It's a big truck, but it's kind of a normal sized car in the US, and people really like it. So that's been really exciting for us. So the tariffs came in at a really unfortunate time, just as we were really starting to take off on a really great trajectory. I think the impact on our customer, obviously we don't want to put the price up at all. And look, if there's a tariff deal, we'll look at pricing again as well. But the Quartermaster is an interesting one. The Quartermaster, we've got a station wagon and a pickup truck, Grenadier Quartermaster. The Quartermaster is also a European-made pickup truck that also attracts chicken tax. So we've taken an absolute double whammy on this vehicle, which is a perfect car for the US market. So yeah, 50% tariff right now on the Quartermaster.
Wait, what's a chicken tax?
So it's a 1960s protectionist measure in the US, which covers multiple industries, obviously started with poultry, I think, but picks up pickup trucks. So in the kind of 3 million strong pickup truck market in the US, they're kind of really seeking to protect that.
That is interesting. I did not know that. We learned something today new. But so you mentioned the Quartermaster, of course, that pickup truck situation. Also, there's going to be potential for new vehicles rounding out the portfolio. What can you tell us about that? And do you think there might be some possibly for electrification or hybridization?
Yeah, so sure. And look, we're starting with the Grenadier and Quartermaster, and despite kind of the tariff discussion, the models are still going extremely well, and we're really continuing our growth trajectory in the US because we really, really see our market as here. So that's going great, but yeah, what's next? Fusilier is our next model, which we did an exterior reveal last year. And that will come in electric, but most importantly for the US market and for us as well, because we're not seeing electric vehicle take up at anything like the rate that the industry and regulators hoped and expected. We kind of thought that was going to happen, to be honest. We think we should be listening to what our customers want to drive. So most importantly for Fusilier, we'll be bringing a range extender, which is a hybrid.
Right, kind of like that e-rev technology.
Yeah.
So in the US, it's a very competitive SUV market. You're going to start rounding out the portfolio soon. Hopefully there's a trade deal that's signed soon for you guys, for the sake of European automakers. How do you compete in the world where you have the Cadillac Escalades, the G-Wagons, BMW offerings, who also is a partner for you guys? How do you compete against the really competitive sort of subset here?
I think it's a really competitive market, and nobody joins the automotive market or enters it with a faint heart, because it's a really tough business. But I think what we offer is something that is almost becoming unique in our market, and it's the reason the Grenadier exists, which is in a world that is moving so far into tech, so far into the car doing everything for you, the car bleeping every time you do something that it doesn't really want you to do. We've kind of forgotten what it's like to drive a car. And we've forgotten that that's actually a really fun thing to do, and with the Grenadier being an off-road car, 4x4, a big truck that can take you anywhere and kind of fuel your adventures, then I think that sort of freedom, that possibility that it gives you is something that's not really on the market anymore.
So no autonomy, I guess, coming down
Not
for you
our
guys.
bag.
Yeah, doesn't sound like it. Lynn, thank you. Appreciate it. Pras, thank you very much. And that's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. More Yahoo Finance coming up.